uh, in a tabular format, which you can actually view right now. So I've tried to see the data from last 13 months, starting from the January uh, to January of 2025. And I have covered data for CPI. I have taken what was the actual CPI versus the estimate. I'm not going by comparing from this to this, like between January to March, February to March. I'm not doing this. I'm just saying that in how many times the expectations were there and the actual came out lighter cool. So in all of this, what I have realized is the number of outcomes where the expectation is less, but the actual CPI is higher is more. You can see on the CPI side. Also on the PPI side, the expectation is low, but the outcome is higher. It's just need to understand this is a different way of looking at the same data. Usually what people do or what everyone does is they do try to compare that from 3.2, it went to 3.4, came down to 3.1, came down to 3.2, came down to 3, 3.1, 2.999. So this way it is coming down from 3.2 to 2.9. It rose, came down, rose, came down. Okay. But if you look in general, right, the actual rise is there against expectation. That's another way because I'm comparing these two fields now, not month on month. I'm comparing these two. This is going to give you another set of flavor. Maybe this is a little complicated, but what I'm trying to say is against every time there's an expectation, the actual is always hotter. In almost in 26 months, it's like 5 and 3, 8. Out of 26, 18 times expectation have failed, and both CPI and PPI have risen higher, which means that inflation is there. Whatever you are expecting, it is not going away. Inflation is there. Expectation was maybe wrong or whatever, but in real term, whenever you have expected something 18 times out of 26, you have failed. Inflation, both CPI and PPI have risen. If I am FOMC head and I'm looking at this data, if I see the vertical view starting from 3.2 in 2024, I am at 2.6. I would see inflation has cooled off. Yes, a little bit, but it is not going away. It is sticking. Similarly here, if you see from PPI 2.7 to 2.5, it will give you a feeling that yes, inflation is cooling. Yeah, but in real world, whenever there is an expectation is based on at that time, there may be energy rises, expectations, all those factors taken into cognizance. So my take is if we are failing on the expectations, right? If you're failing 18 time of 26 on the expectations, then there is something wrong. It means that inflation is not coming down. It is stagnated. And in fact, it's holding up and may go higher. Now, 25% tariff on Mexico is coming. 25% tariff on Canada is there. Mexico, if Colombia is also 25%, these two tariffs are going to increase. Like tariffs is not simple. The impact of tariff is, let me just clean this. Like supposedly this is a Colombian person. He's selling fruits. and coffee. Mexico is selling maybe, let's say, sugar. Previously, they were selling it at $100 per quintal. They will be selling at $100. Adding 25%, meaning they will be selling it into 125 and 125. Now, it doesn't mean that USA, which was a buyer of fruit and coffee at 100 and sugar at 100, is going to go to some other country all of a sudden and start buying these products. USA will be buying them at 125. So if a USA manufacturer or a factory owner or somebody buying at 125, is he going to sell to the customer at the same price of $100? No, he will pass on that price. So maybe the end customer was taking at $1. Now he has to buy at $1.25, which will increase the core CPI. Food. Also, Trump has said that drill, baby, drill, but drilling will not start immediately. It takes its own time. It's not going to happen right away, maybe in 6 to 12, maybe 18 months. But before that, the price of natural gas has gone up. There's a good amount of cold spread in the Northeast. In fact, Texas also and Florida also had snow. So that will also come into cognizance because January was really cold. And with LA fires, all these things, the demand for housing, lumber, construction things, everything will go high because the amount of infrastructure burnt in LA is enormous. All in all, this data where we are failing on the expectation and the decrease is not substantial. In fact, it's kind of coming back and holding. If I'm Jerome Powell, with all the tariffs, with all the uh, things which I just talked about, will increase the demand for lumber, for construction things, everything. They give a good part of what you call CPI. Now, health CPI has many factors. Healthcare is one of the important ones. Rental is another one. Rentals have not come down because the mortgage rate is still risen. If the mortgage is higher, rentals are still. So all in all, I don't see FOMC, especially Jerome, saying anything dovish. He will be hawkish. He will be hawkish. He will say things are in bad shape. Again, that's my expectation because looking at all this data, I think the commentary from Jerome Powell will be highly hawkish, which can actually be troublesome for the market because market is assuming good bang cuts from Jerome Powell. Last time he spoke, we saw some substantial cut in the market. This time, I think he's going to repeat. Trump is going to push for rate cuts, and they may not happen because if the rate cuts will come now, the bond market is not accepting it. If you look at the bond market, let me also open the investing.com link. Let me just open it and bring it. In between, guys, I've also shared the Zoom link. If any person who is interested to join can join and ask me meaningful questions, I will be happy to answer. Okay, so let's go to economic calendar. And you can also see that the demand is going down for consumer goods. It means customer is facing that inflation. They know that there is something which is keeping prices higher. The expectations, consumer confidence is down. Expectations of consumer confidence can only go higher if they see that the prices of things will come down. Right now, that is not happening. So if you look at this, 30-year or 10-year, they are not far from their all-time highs. Like if I go to 1 year, it's right there. 4.8-ish is 10 years yield, which is about 5% from now. High 30-year was, I think, 5.4977, almost 5. Uh, on the higher time frame, let me open. Come on. That's why I don't like investing.com. It just forgets. But this gives you an idea. Uh, when you look at the bond prices, just keep in mind that yes, 30-year bond is not coming. Even after 2 rate cuts, the bond market did not come down. Look at this. This was a cut in September. The yields go up. Yield is the risk. Yield is the interest on which the US government pays to its borrowers. So yields is going higher, currency is going higher because everyone believes inflation is going to come, right? So just be careful. Hawkish commentary can kill the market like it did last time. So my take will be, if you are long, better to book the longs into the uh, FOMC conference. Rate, there will be zero rate cut or hike. It will be totally zero. It should be flat. But the commentary will be really, really important. And looking at the volatility in the market, I think we are ready for some big fireworks tomorrow. Earnings will not matter if the commentary is really hawkish. So just be careful. On the other side, if he is dovish, market is already at a high, that time there may be a rotation from big stocks into IWM. So net, everything telling me to book profit in the long and stay out of positions into this conference. Now, sorry. Once conference is over, you can always go back to the positions. All right. Any questions on the CPI, PPI thing which I shared? I'm gonna put this data onto the Twitter, explaining my rationale, because I'm not comparing month on month. I'm comparing expectations versus actual. And whenever we are missing, and this is a different view. Again, I'm going to reiterate, this is a different perspective of looking